Hello everyone, today is Friday, April Fool's Day. My name is Evan. Welcome back to our weekly stock market analysis video series. If it's your first time tuning in, welcome, thanks for being here. Here's how these videos work. We break up our analysis into two parts. In part one, we look at everything that went on this week in markets, going beyond price action and really sort of picking apart things that stand out or look interesting or different in the data. And then in part two, we jump into the charts. We look at some specific price action and try and make sense of where we are. So hopefully that sounds good to you. Let's jump into some of the headlines from this week. I think the big takeaway here, first off, is stocks sort of feeling a little bit tired, failing to make new highs. Now, stocks are still, in my eyes here, extremely resilient, but they clearly, as we'll look into the charts here, have failed to hold on to the early gains this week. We traded off of those highs, and it was certainly a mixed picture depending on what sectors or industries you're looking at. We did see some volatility out of oil. We see this magnet sort of volatility, kind of happening here around the $100 mark of oil per barrel. And we did see U.S. interest rates start to cool off a little bit, just a little bit. We certainly have the yield curve inverted now, which certainly is all over the headlines and lots of talk about that. It was something we started to mention last week as some of the spreads started to invert, and that seems to be on everyone's mind right now. So if we take a look here at performance on the week, you can see again, positive. Dow Jones, S&P basically flat. The Nasdaq ended up about almost 1% higher. Russell 2000, 0.5% higher. But these were all numbers that were off of the highs of the week. And if we look at world stocks, we did see a little bit of a recovery there. Remember, we had some relative outperformance we noted out of international stocks. Then they started to give some of that back. But you can see now on the 1 month return number, so this middle column here, we've got a more even race going on across all of the equity market indices. We've got the Nasdaq 100, which is the clear sort of winner right now, 7.4%. Over the last month, it was also down, one of the largest the prior month. If we take a look here at trends, so as you can see here, I've reorged a little bit of the template here, and I wanted to stick sort of our trend analysis in here just to give some context to the numbers. So this is our custom smart trend filter indicator. We've built it for TradingView and TC2000. So if you're a user, you can get it. We're looking at a screenshot from TradingView, but this is a weekly chart on the S&P in the top left, Nasdaq in the top right, Russell in the bottom left, and international stocks in the bottom right. And basically you can see, whether or not we've got a green, yellow, or red dot printed. It's pretty intuitive here, measures trend and trend strength. And you can see basically in the S&P 500, we are above this indicator, but it's still, kind of printing those warning signs, and the prior signal was down. So we need to be cautious here. It is a good recovery, the fact that we are holding up above this indicator, but we do need to just, again, tread a little bit carefully here, given the fact that we've got lots of volatility and we've got this sort of mostly downward sloping indicator. Same thing for the Nasdaq 100. You can see, again, very positive this week that we're holding back above it, but still, 2 weeks in a row now, we've got yellow dots printed. Prior signal was down. Russell 2000, first time it is now testing and trying to transition back up here on this trend analysis. You can see it's been many weeks now, many months to the downside. That's starting to change. Same thing with international stocks. So that's our longer term sort of, very easy to visualize and understand trend outlook there for the major markets. Now, if we go underneath the hood, we take a look at market internals, you can see that we are getting a little bit more constructive here on the number of stocks hitting 52-week highs. So NYSE 52-week highs minus lows, this is an indicator statistic that I really like to track closely. It's one of my favorites for market internals, and that is starting to, move in the right direction. Many of those stocks are energy stocks, so it might not be the risk-on tech sector, aggressive kind of trader mentality type of name, but it is still, at least a measure there of broad-based sort of equity market strength, and we'll respect it in the sense that it is trying to even out and turn up a little bit. If we take a look at the AD line, you can see that was strongly positive this week, and there's still 73% of stocks above a 20 SMA, so it's pretty strong out there. Now, if we take a look at this NYSE 52-week highs minus lows, plotted over the past 30 days, again, you can see we're still in this very sort of, interesting state here. We had a steep downtrend in place, and now we're starting to just basically tread sideways, slight incline. So we really want to see this, continue to improve. We want to see this get back up. We want to see the cumulative number here get back into positive territory. That's what we're going to be paying attention to right now. Still a little bit suspect, trying to improve. If we take a look at volatility, so the term structure, not a big change. So this is now sort of comfortably in week 2 now, where we are sitting with about a 20 VIX here in the front month, which is pretty impressive given the fact that, again, 2.5 weeks ago, we were trading north of 30. We're continuing to kind of hold, these levels down here right now, and the market is sort of accepting it at this time. So this is, starting to move back into more constructive behavior in my eyes, but I don't think we're necessarily out of the woods yet. Last week I was sort of cautious on this or concerning on this, given the fact that we did just see, a 40-50% sort of, wind come out, momentum come out of the VIX sale. And the fact that, again, we didn't just springboard back up this week gives a little, starts to give a little bit of credit in my eyes if I'm putting my sort of discretionary hat on, looking at how this is all working in relationship to all these other markets in rotation. If we take a look at sector performance here, you can see lots of green. So real estate at the top of the list, 4.5%. Utilities, big move there, 4%, trading at highs. Staples, 2.15%, definitely, and then healthcare in the 4th spot. So you definitely have a defensive tone here. You've got utility, staples, healthcare, so that's not your ideal risk appetite. On the downside, financials took a beating here, 3.29%, underperformer this week, followed by energy and industrials. If we take a look at interest rates, again, we talked about, yields finally starting to cool off a little bit, but take a look at those 1-month numbers. Take a look at the 1-year numbers. And again, we're talking about percentages of percentages, so this can look a little wonky, but the point is, we've had a very strong move here in yields, as I think everyone is probably aware of at this time. And this week, we're finally starting to maybe cool off a little bit, but those trends still down here, or I guess up in the case of yields, down in the case of bonds themselves. If we take a look at credit markets here, investment grade, high yield, both up this week. That was constructive as they, are trying to lift up while stocks close towards their lows. If we finalize here with the US dollar and commodities, you can see the dollar index did finish lower this week, as did most commodities. So gold, silver, Bitcoin, ag, WTI down 8%. Natural gas, the only thing green this week. So at least in this list, there's obviously a lot more commodities we could track, but generally speaking here, down dollar, down commodities for the week. Finally, correlations. Wanted to touch on correlations here. You're seeing a lot of bright green up in the top left. So you're basically still seeing risk assets trade just with one another. There's not much separation in the indices. You're seeing just basically broad-based rotation, risk on, risk off. You'd also have that very strong inverse correlation to the US dollar and to long-term bonds. And again, you're seeing JNK, you're seeing even Bitcoin starting to correlate pretty strongly here with equity markets. So that is still, again, a little bit suspect there. This is generally a time of stress when you start to see these very strong correlations with one another. But we're going to keep an eye on that. These are 10-day correlations. So last but not least here is our trading system. So we run 2 fully rules-based systematic trading systems here at the Trade Risk, and our top system, Merlin, is a longer term system, holds positions for about a month. You can see that exposure continues to come down. This is a theme that you've basically seen over the past month or so, or even longer, I guess at this point. But we've seen, basically this portfolio go from, 80, 90% to all the way down to now 34%. So we are continuing to raise cash, did hit some profit targets this week, was allow us to sort of take some chips off the table. And right now, not so inclined to buy back anything, at least at this time. We'll see how things fare next week. Our shorter term system here, a little more aggressively short. So in aggregate now, is sort of allocating to both of these trading systems to create one master sort of portfolio, do lean to the short side. So last week, I think we were still marginally net long. Now in aggregate here, we are a little bit net short the market. So not a big bold position, but Lamerick, this shorter term system is certainly taking a little more of an aggressive stance. So these are two trading systems. They get updated every day, produce end of day trade signals. We've got memberships for both, and we've got a trial for $1. You can take that. There's a link appearing in the top right hand of your screen. See if those systems can help you out. And with that, we'll be back here in just a moment with part 2. All right, we are back here. We've got Warden TC2000 open, and we're going to jump into some price action analysis here. So I wanted to start with this very simple view. This was a chart I've had drawn on here for a few weeks now, and this is something sort of our very simple roadmap when we started to break down in late January and then start to bounce in early February. We sort of framed out this very simplistic view about price action and where we could head. And we talked about basically the zone down here around 4,300 down to around 4,280 or so. It was approximately the third quarter lows from 2021 to where we rebounded here, undercut and sort of rebounded. And, spent basically 1 week below it and then popped aggressively back up. Now, on the upside, we had this 4,550 to 4,600 zone. This was sort of the very broad sort of crayon range that we needed to see this market break out of to the upside. Otherwise, it would still be considered resistance. And as we see now very clearly from this week's trading, we got another attempt here. So the market made a good, solid attempt at breaking out through these January, February highs, through the 4,600 zone, and all said and done on the week, we rejected those prices and closed in the lower quarter for this week's range. So for me, this is a sort of signal here by the market that we did not accept those higher prices. We did stall out, and we did see sellers kind of come back in to sell for value over that 4,550, 4,600 zone. So the levels, I think are pretty clear right now. We've got, you could alter this sort of crayon drawing here and sort of look at these February highs and look at this week's highs and really sort of draw some line in the sand here around this 4,600 zone as the real sort of truth or momentum breakout area. And right now we're below it. And it's something we'll want to pay attention to as we go through next week. You can see, of course, now on the daily chart, we basically had 2 days down here on Wednesday and Thursday. We tried to go lower on Friday, but we reversed and sort of closed that last hour of the day. We saw lots of rebalancing or at least funds and pressure come in to buy stocks. So 45, 45, 45, 45. That is where we close going into the weekend. I think we've got some pretty clear levels right above us here. We are, we worked off a little bit of those overbought conditions. We were pretty extremely overbought. I mean, the market has gone up in a straight line from low to high about 11%. And so now that we've got a 2% correction off of that, at least we worked off a little bit of those overbought readings. So we're going to want to take this now one day at a time. We want to see how the market settles in here. Can it actually hold around this 45-40 area? Will these lows hold from Friday? That would be very impressive if we just rebound, if we just start the week higher on Monday and then start cruising over 4,600. That would be very impressive strength and would be something to take notice of. I don't necessarily believe it's the highest probability scenario at this time. I want to be a little more suspect here at the top of a range, holding just under resistance. So let's keep an open mind, but let's respect the fact that we did sort of fail over 4,600. We need the market to sort of prove it if we can get back over that range. That's about it. I mean, I don't really want to complicate it too much more when looking at all of this. I mean, we can throw Bollinger Bands on here. You can see they've just been really expanding up, which is just showing you that we've got that vol expansion to the upside in this case. We do have MACD that's in positive territory. So there are bullish, developments happening, but I still want to be just a little bit cautious given the macro environment, given the fact we're 10, 11% off of the lows and coming back into that prior supply. Now, if we go to, say, the IWM, you can see very similar here. We had some pretty high stakes levels. We'll take off those Bollinger Bands and look, say, at this zone here, and you can see, the infamous sort of year-long range in the Russell 2000 between that 210, 230. We broke down from it in the first quarter of this year, and we've been kind of chopping sideways. We essentially paid our first official retest to this zone here over 210. We spent just a day, one session that we closed over this area, and then we came kind of swiftly selling on Wednesday, Thursday, recovered a bit on Friday. So this really does have kind of that same look and feel. I think the level's pretty clear here around 210 all the way up to say Wednesday's high, or Tuesday's high rather, and we'll need to see if the Russell 2000 can start getting price acceptance over 210. That would be constructive if we can start getting back into this old range, but I do want to be a bit cautious as we have recovered off of these lows. And last but not least, if I want to look at the Qs here, we've got kind of similar pattern where we tested the February highs, and so we got one day closing over 370 and above the February highs. But again, if we look at this weekly chart here, you've got this long tail on the upside, closed in the bottom quarter of the range. So I want to be a little bit cautious here. You can see again, MACD is in positive territory and did work off some of those overbought conditions. So let's keep an open mind, take it one day at a time. But I think the levels all point to pretty clear here at the February highs and recent highs of this leg. So that's what I'd be paying attention to. Not necessarily too excited to dial up the risk on exposure at this level. If I am going to play that game, if I am going to go for momentum and a breakout in the market, which could happen to the upside, I just want to be very mindful of kind of having that stop loss in place, having the risk measured, and willing to sort of cut loose if the market turns south. So that's sort of how I'm framing up this price action here. If we take a look at two charts, I wanted to look at oil first. Oil here, you can see starting to see some volatility. We talked about it thrusting off of this sort of area here and trying to put in a higher low. Well, it certainly, tried that, but the problem was it didn't even get back up towards these prior highs before it sort of rolled over and made what is, kind of looking like a lower high. So we've got this sort of volatility compression here, or we've got this range compression going on, and we've got price kind of sitting here at this $74 mark, which is again about $100 a barrel oil if we're looking at WTI price. So, we really need to, important market to pay attention to. And that's why, it's worth kind of calling out here, is because, oil, energy stocks, and just the commodity trade in general, inflation. I mean, this is driving, right, a lot of macro right now. Energy is, a big story here, and we are looking at those energy stocks as sort of being some leaders in this market. So it is interesting to see what happens at this state. Right now, it does look like some vol compression. Volume is dried up. So let's keep an eye on, say, this recent low, this recent high here, and you're starting to get just, again, that range compression, which is good for traders to manage risk against. Last but not least is GLD. I want to talk about GLD. You can see it's still going sideways here. So it had this big kind of blow off, runoff move up to around 193, 194, about 193. And, we're basically 7-8% from those highs, still going sideways here. Volume is drying up. Again, getting some good range compression in here. I don't really see anything too attractive just yet, but I am watching this range. More compression here, I think, is a good thing. I would ultimately want to be a buyer of gold on some type of breakout, but still seems like it's too soon. It's possible it's, going to make this next leg down, a second leg down, I should say. So I'm, just eyeing it and, watching this, but it is something I'm interested in buying if the setup starts to emerge, but nothing too exciting just yet. So last but not least, industries and sectors of interest. This scan, this layout is now available on our website. We've had lots of people asking for this for a while. We finally got it up. And if you are a TC2000 user, you can get this layout. And you can run the same analysis we do. It basically highlights over 200 sectors and the individual industries and sort of picks apart things that look that are making notable moves that you may want to have your attention on, that you may want to focus on as trade ideas as an industry. So let's run through a few of the bullish ones right here. We've got consumer defensive beverages making new multi-month highs. We've got beverages and wineries, again, making a nice move here, third week in a row up and making new multi-month highs. Let's see, am I going back and forth on the same ones? Let's move it. Yes. Okay. So biotech, number 3 here, high volume kind of coming in, above average volume, at least coming in and trying to make kind of a notable move to the upside there. We've got business services, heavy volume coming in this week. We got conglomerates trying to lift out of a range. Got new highs here for farm. We've got industrial metals and miners, heavy volume coming in, new highs. We've got insurance breaking out to new, trying to break out of this range here to new highs. Medical devices resolving this range, trying to start moving back up to the upside. Healthcare again. Consumer defensive, we got REITs. Gonna move quick here. Lots of REITs. Staffing and outsourcing services moving up. Communication services, telecom, this was been in a range here, moving back to the top of that range. We've got utilities making that big move, talked about that earlier. Industrials, waste management specifically, real estate, biotech, and staples. Lots to look at there on the upside. Now on the downside, there's still a handful of names as well. We've got kind of this high volume reversal to the downside in advertising agencies. We've got auto and truck dealerships making fresh new lows here. We've got building materials closing at new multi-month lows. We've got capital markets. Again, we talked about financials being weak. Saw that outside reversal, heavy volume coming in, looks a little suspect. Home improvement making new lows. We've got lumber and wood production, new lows there. We've got pharmaceutical retailers, heavy volume, new lows. Industrial trucking specifically, heavy volume, new lows. Last but not least is semiconductors, not new lows, but an outside kind of higher volume, more pessimistic sort of weekly candle here. Something to take notice as this drives a lot of that risk tech appetite. So that's what I got for this week. Changed up the format a little bit. Let me know if you have any thoughts on it. We're starting to iterate, starting to work in some new data sets, hopefully over the next coming weeks. And I do have a bit of a tough scheduling conflict next week, so I'm going to try my best to do a video. Might not happen, might be delayed, but I'll see what I can do next week. So that's it for me. Thanks as always for tuning in and watching, listening. Every Friday we do these videos. Do subscribe to our YouTube channel. Check us out at thetraderisk.com and leave your comments below. Let me know what you're looking at this weekend. Always love to know what people are interested in and have for thoughts on this market. So that's it for me. Thanks as always. Have a great weekend.